Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about revenue recognition, why it's important, how it's been changing, and the 5 key principles or methods or steps, whatever you want to call them, that FASB has introduced as the new revenue recognition standard. Now, as part of that process of discussing these basics, we've gone through 2 different simple examples with 2 different companies, walking through the whole process from beginning to end. Now, in these next few segments, we're going to take those basics that we've learned and apply them to more advanced situations. Specifically, we want to look at what happens with multiple deliverables. Again, we've looked at that already for a simple example. We want to do that with a more advanced example. And then we want to look more at what happens when we can't deliver in a reasonable amount of time, and we want to recognize the revenue as we go. So that's kind of a preview of what's coming. Let's jump right into the first of those more advanced transactions or scenarios, and that is recognizing revenue with what we call multiple deliverables, meaning we have several distinct obligations that have to be recorded separately. Now, the reason I want to look at this again is because of 2 important concepts that a lot of students struggle with. The first is the idea that I recognize revenue as each piece is completed. Piece by piece by piece, I recognize the revenue. I can't recognize a little bit of revenue for this part and a little bit for that part of the contract. It is I complete each distinct obligation, I recognize revenue. So we want to practice that. In addition, people have trouble recognizing the correct amount of accounts receivable and the correct amount of unearned revenue. So here's the basic principle, and again, this is one of our key concepts. You only recognize accounts receivable for the amount that you have earned but not yet received. And you can only recognize unearned revenue for the amount that you have received but not yet earned. And again, we don't call it unearned revenue as much anymore. We're going to use that new contract liability term that FASB is pushing for, but it's an unearned revenue is still the idea behind that account title. So those are the 2 main pieces that trip people up as they learn this new method. I can't recognize all of the accounts receivable on the whole contract, and I can't recognize all of the unearned revenue on the whole contract unless they've actually paid me. So I have to just recognize based on what I've received or earned. As long as you're comfortable with those 2 important ideas, you'll be set as far as dealing with multiple deliverables. So with that kind of as a background, let's jump into this example. MSH Incorporated recently sold a computer system to a new client. The sale includes hardware, software, a maintenance contract, and a training contract. By the end of the current year, the hardware and software had been installed, but they hadn't yet performed the training. Each component is sold separately by MSH as well as part of this package. Normal prices are $7.5 million for the hardware, costs us a little over $5.6. Software we sell for $2 million, costs us about $1.8. Training is $200,000, costs us $100,000. Maintenance contract is $300,000, costs us $60,000, and you can see the package price is a little bit lower than what we would get if we sold each piece separately. And then the cost, we just add up all of the costs from all those different pieces. So that's our information. So step 1 of recognizing revenue is there a contract? And again, we're not looking for whether legally there's a contract or not. We're looking for whether there's a gap contract. And the gap contract means, remember that the amounts I'm going to get are spelled out. We know that. What we're going to get, what the client's going to get is spelled out. Is it probable that we're going to get paid? If you look down at the bottom, we've already gotten some of our money. So there's a couple other things, but it looks like we've got a contract. So we're going to assume that step number 1 is okay. We have a contract. The next step is to figure out all of our obligations. And if you look at our list here in this first bullet point, we've got hardware, software, a maintenance contract, and training contract. So it looks like we've got 4 distinct obligations. Now, people could argue, wait a minute, you can't do the maintenance contract unless you sell the hardware, and you can't put the software on without the hardware. So maybe we've only got 2. But if you look down here in the 3rd bullet point, you can see that we sell each of these separately, which means they can buy just the hardware from us and they could go get their own software or make their own software. So I can treat the hardware as a separate standalone obligation. They can buy the software from us, but they don't have to. Again, they could write their own, and they don't have to put it on our hardware. They could have their own hardware and just put our software on it. So that makes it a distinct obligation. Training, they don't have to buy the training, and they could buy it later. They could try on their own, and if they can't learn it, then they could come back and get the training. So because it doesn't have to go with the software, they can buy it separately. That's a distinct obligation. And again, the maintenance contract, they don't have to buy it. They could maintain it themselves, but they can buy it if they want to. And since we sell it alone, they could come back and buy it, or they could rebuy it every 12 months. So again, it becomes a distinct obligation. Again, can you debate that? You bet. But chances are our best interpretation, at least at this point, is that there are 4 distinct obligations. So that's step 2. And we'll say that it's done. We've got these 4 obligations. Step number 3 is to figure out the transaction price. Down here is what we get for a package, and I have no information suggesting that I'll get more or less than that, so that's my best guess. So that right there is step 3, that we will get 9.2 million. Now, hopefully you've noticed, we went through this and took a long time during those first few segments, walking through this process, but the reality is, this can go really fast, especially as you get the hang of it and you get the feel for different contracts. It doesn't have to be a long process. Now that we know the first 3 steps, we're ready to move on to steps 4 and 5. Our step 4 process is to break down this 9.2 million and assign it to the 4 distinct obligations. So step number 4 is to make our table. So we've got our obligation, the normal price, our standalone price. We have a percentage, and that will give us our allocated obligation price. So now that we've got the setup, let's put in what we know. We've got our hardware, software, training, and maintenance. And we've got our prices and our costs back here. So here's all of our prices and our costs. I'm just going to transfer those over. And while I'm at it, I'm going to put the costs off to one side of this table, just so that I have that information too when I start to do my journal entries. So normal price, standalone price, $7,500,000. And the cost is $5,625,000. Software normally sells for $2 million and costs $1.8 million. Training sells for $200,000, costs $100,000. Maintenance is $300,000 and costs $60,000. And now I've got all the information that I need here, so I can finish step 4 and move right on to step 5. If we add up our normal prices, we end up with a $10 million price tag for all of these items, if we were to sell them individually. And now I can divide. I take the 7.5 million divided by the 10 million, and I get 75%. And then 2 million divided by 10 million, 20%. And we'll just keep going here. 200,000 divided by 10 million, and 300,000 divided by 10 million. And if I add those up, which I always do as a check, there's my 100. My allocated price, remember that contractually 9.2 million is what I'm spending on this contract, or what they're paying me for this whole contract. So if I take 75% of the 9.2 million, I get 6,900,000. 20% is 1,840,000. 2% is 184, and 3% is 276. And again, as a check, we want to make sure that adds up to the 9.2 million, which shouldn't be a problem as long as you got 100% over here. But just better safe than sorry, especially if you've had to do some rounding. Next, we get to step number 5, the best part, the journal entry. Let's go back to our information. So at the end of the year, the hardware has been installed and so has the software, but I haven't done the training. And if I've just barely finished the installation, then I haven't done any maintenance. So these two pieces have not been done yet. It's just the first two. So I need to do the journal entry to record the revenue on the pieces of my contract, the obligations that I have already completed. So let's do this journal entry, step 5, just for this year. Let's get our sales revenue in. And it's these two pieces. So 1.84 plus 6.9 gives me $8,740,000. That's my sales revenue. In addition, we've been told, let's go back, that they have paid $1 million up front. So I have gotten $1 million. And we'll just make that part of this journal entry as well. So cash, 1 million. Now what? Well, a lot of people want to recognize everything. So they want to recognize accounts receivable of 8.2 million so that I can get the 9.2 million on the debit side, and then recognize an unearned revenue or a contract liability for the balance on the credit side. But it doesn't work like that. What we do is we recognize accounts receivable up to what we've earned or unearned revenue based on what they've paid. So I don't recognize everything. I just recognize what I've gotten, either by earning it and the promise that I'll get it, or because they've actually paid me the cash. So in this case, I'm not going to show the full 9.2. I'm only going to get up to the total that I've earned, 8,740,000. So accounts receivable, 7,740,000, and I will show no unearned revenue unless they pay me here in January. Then I'll record the rest of the accounts receivable being paid, and I'll show an unearned revenue that I'll slowly earn as I finish the training and finish the maintenance contract. But as of the end of this fiscal year, that's it. No more. Except, of course, that I have to have the cost. Remember, that was another of our key concepts, is that you have to have the cost with the revenue. So the cost, that's these two pieces. So we'll call it cost of goods sold, although you can call it cost of sales, 7,425,000. And we will take that out, probably of inventory. That makes the most sense, given the information that I've got. Hardware and software installation. Now, hopefully that process makes sense. Remember that we don't want to recognize any accounts receivable that we haven't earned, and we don't want to recognize any unearned revenue or contract liability that we haven't gotten. So we're trying to match up as best we can with the actual revenue numbers or the cash flow numbers that we've gotten. That's the goal. And if you can remember that, then you're well on your way to understanding one of the challenges or fun parts of this revenue recognition process. Isn't it exciting? We got to do another journal entry. We've got more good journal entries coming up as we move on to perhaps the most exciting piece of what we get to do, and that's a more detailed look at what happens if we want to recognize the revenue before we actually complete the different parts or obligations of our contract. So more fun stuff coming up. We'll see you then. Thanks.